was the banks which were problem pocket for the market. Let's see whether HDFC Bank and Kotak Mahindra Bank actually lift their weight and pull their weight on the Nifty Bank from current levels as well or not. But speaking about banks itself, we have Karnataka Bank on our radar, gaining on the back of its strong set of second quarter earnings. We are joined by Srikrishnan H, the MD and CEO of Karnataka Bank, to discuss the past quarter's performance, but more importantly, look at the future and give us a peek into what that holds as well. Thanks a lot for joining in, sir. Deposits, that's been a bit of a scramble for the entire industry. So what is the kind of deposit growth that you're targeting for this year? And on the back of that, maybe if you could give us a sense of at what rate will your loans grow this year too?
Good morning, and thank you for the opportunity. As you had mentioned, yes, we have had a decent quarter. On the deposit side, we've been growing at about 13 to 14% on a year-on-year annualized basis, and we'll continue to grow. The last year was a real turnaround for the bank, the financial year, and we have demonstrated the similar trend in the first quarter as well. As far as advances are concerned, it's a stated objective of the bank that we will reach 100,000 crore by exit March 26. So we are well on track, where we grow by about close to 19%. And we are growing on retail assets, which is a good sign, as well as very high-yielding assets on the mid-sized corporate and SMEs also. So overall, I think, we are on the right trajectory.
Okay, that's good to hear, sir. And thanks a lot for joining in. So we've got the loan growth number out of the way of around 19% and deposit growth of around 13% or thereabouts. What about NIMs? Sounding quite confident on the deposit growth. Will it have an impact on the NIMs, or do you think the high-yielding portfolio will be able to take care of it? For the last quarter, you have reported around 3.5%. What's the range we should work with?
Our guidance has been 3.5 to 3.7, and we stick to that, still. There are two reasons for this. One is that, our very strong branch franchise, which is about 940 branches as we speak to you today, and they are kicking in on retail term deposits as well as CASA. The second is that we have plans to develop a lot of features and new product rollouts in the liability side. We started with the senior citizens, savings account, followed now with self-employed professionals, entrepreneurs, in millennials, education and staff, students, etc. The other thing is that we have focused a lot on current account accretion through 2-3 products that we have launched, including a corporate payroll process account. Yeah.
Okay, that's good news. But now let's focus on the asset quality. We've got the growth numbers as well as the NIMs of around 3.5 to around 3.7%. Tell us more about asset quality. The slippage ratio is, I think, around that 2.5% or thereabouts, 2.2% of the last reported quarter if I annualize it. So what is the slippage ratio that we should work with, and the asset quality numbers as well?
About 0.8% has been our quarter slippage ratio now, and I think we stick to that. There is a historical book, I should admit, and which is pre-COVID, and the kind of pressure that we have. But the good news here is that the total of our GNPA plus restructured asset book, which as a bank there was a very conservative stand that was taken, has come down to less than about 5% of the overall book, about 5.3% to be very precise. So this is good news, because directionally we are moving down quarter on quarter. Recoveries are happening in full swing, both the technical write-off book, which is directly into the P&L, as well as reduction in the overall NNPA. So directionally we are coming down quarter on quarter, and also with the corresponding quarter of the last year. So NNPA, while it is a little high still overall compared to multiple other peer banks, because most are near the 1%, we would target that net NPA would reach closer to about 1.2% by the end of this financial year.
All right, so 1.2% by the end of this financial year, at a time when everyone else is around 1%. You're looking to improve your books, the asset quality from current levels. Last year was a start into that journey. You are looking at almost 100,000 crores in terms of a loan book over the next couple of years as well. So let's talk about a couple of other things too then. In the loan growth that you're talking about, 19% over the next couple of years, where is it that you're seeing the most amount of traction when it comes to demand for loans, and where is it where the sell is a little too hard? We're just trying to understand what are the higher yielding assets for you, lower yielding assets for you, better quality. How do you manage that mix over the next couple of years?
Focus is on RAM, which is basically retail, agri, and mid-market, and this is going to continue. And over 50% of our accretion is all happening in this space. Our loan book is divided about a third or a little more than a third with large corporates, where we have said that we will get out of the bulk opportunistic kind of loans into direct to corporate lending. So we're strengthening our corporate business, mid-sized corporate business, with coverage teams and relationship teams across the country, at least for the main locations. Our industrial finance branch, corporate finance branch, and overseas branches are kicking in very well in the major locations. Last but not the least, we believe that the growth will be more granular to the tune of about 50+%, and towards a larger, let's say, ticket sizes for the mid-sized corporates and so on. The yield is obviously good from a retail perspective, although there are several challenges. We are setting up a collection system. We are also completely revamping our credit processes in terms of turnaround times, and we have plans to set up some very specific retail asset centers in major locations as we go forward. As far as the larger corporate is concerned, I think there is a lot of balance sheet lending. The good news about the bank is that about 90% of our overall loan book is still collateral based. Unsecured is a very, very limited portion, and which is only relevant to large corporates or PSU or some opportunistic corporate asset that we have taken. For the first time in the history of the bank, we would be getting into the unsecured space, for which we are strengthening both the processes, technology, and the collection mechanisms. And we will get there. There are a slew of products that we are launching, particularly on the digital space, where digital origination of retail loans, particularly related to UPI. So we will be launching a credit line on UPI very, very soon,
right,
and followed by a few other products on the retail space, which will be our charter into the unsecured territory for the first time.
All right, that will be very interesting. If you go into unsecured territory, maybe your yields will increase, but you are strengthening your collection processes, etc. as well. Just before we let you go, just wanted your word on two things. One, with all these things happening, one presumes that your cost to income ratio would increase. So what is your target cost to income ratio here as you are expanding? And secondly, with all of this, is inorganic a part of your mix? I mean, are you looking at some opportunities to maybe strengthen your capabilities, get books, or maybe get merged into someone else with the kind of capabilities that you have right now?
So you asked me two questions. One is in terms of the strengthening part related to our book and the overall processes, etc. Yes, there's a lot of effort. As you know, we have raised adequate capital, so that has created a lot of headroom as far as the overall infrastructural setup is required, and also setting up large back offices and national back offices in Mangalore. The second part, what you asked about, is the inorganic side. It is an opportunity that no bank would like to miss, and so we are. So we would be looking at any such very interesting opportunity. Book growth is not our objective. I think if there is distribution and everything related to the overall infrastructural strength that we acquire, definitely, we would be looking at it. And to answer the last question, that, are we looking at merger? I think we are looking at acquiring rather than being merged. So we are looking at some kind of acquisition, if at all that it comes. But I would not like to want any speculation here. So just to reiterate that, this is something which is a normal process where we would be on the lookout for any such interesting opportunities.
Okay, and what about the size of the opportunity that you're looking at in this inorganic growth? For years, I'll tell you why I've asked you this, because for years, there's been that murmur that maybe Karnataka Bank will get acquired. Now you're saying, no, that's not the case. We are on the lookout. So some size, some timeline, sometime during this fiscal year, we should hear about it?
I think that, this is a murmur, and which will continue to be a murmur. But on the other side, we have strengthened our balance sheet. We have strengthened our capital. We have strengthened our management team and all the infrastructure related to technology and architecture. So there is no way that, it is something which can remain a murmur like that anymore, one. Secondly, I do not want to really say any timing here, because this is very opportunistic in terms of the market. So as and when we do see some strengths that we can acquire through this process, we would certainly be open about it. And as I said earlier, I reiterate that we are growing our asset book by ourselves at about 19%, which is much ahead of the market. So we believe that a balance sheet size our overall business turnover,
Right.
which we crossed 1,75,000 crores, which was about 1,45,000 crores about a year and a half ago. So this is very clearly an indicator that the growth is there as far as the bank is concerned in a very organic fashion. We would continue to push that forever.
All right, we take that point. Thank you so much for joining in and giving us the clarity on what you look at for the bank for as a way forward. That's about Karnataka Bank. The stock holding higher on a day where the Nifty bank